Hi, let's cover my Elliott Wave analysis on Bitcoin, and in this video I will explain why preferably locally I look for a bit of a bounce towards the upside. Now ideally I would like to see another range, another move down into areas of support that I will show later in the video, and I look for a move towards the upside, but in general we have here an overlapping structure, sharp move to the downside on an increased amount of volume, and then here we start slowing down again on decreasing volume into areas of support, which makes the support very interesting, and it increases the probabilities to look for a bit of a bounce. This is the trend and turn methodology as per Kuhn's theory. But if we use Elliott Wave Theory and we're going into labeling, then what you can see here is that we would count this last structure to the downside since 107.5k as an impulse. It's quite tricky to count this as a nice three-wave corrective structure. And if we would look at the higher time frame and we want to count a diagonal 1, 2, 3, 4, 5 here, then you want this to be a three-wave corrective structure if this is an ending diagonal of a flat in wave A, wave B, and a wave C. An ending diagonal consists of three-wave structures internally. Every wave in a ending diagonal should be a three-wave zigzag family structure. Now, as covered before, the diagonal itself is a little bit tricky due to the first move down looking like a five-wave structure. Here on Coinbase, of course, we have a bit of a wick. Now, one might then consider, well, what if this is a wave W, ABC, this is X, and here we have another ABC down in a wave Y? That would be an option on charts that have this wick. If we, however, go to the CME chart, it becomes a little bit more tricky to count a nice three-wave corrective structure to the downside here, because this then would be your ABC. That's your W, that's your X, and then this has to be your ABC in a wave Y. So X is very, very shallow over here. It just doesn't look as neat. And I suppose if I would show you only this part of the chart and ask you, is this motive or corrective? Most of the people will likely say, well, that looks like an impulse, 1, 2, 3, 4, 5 wave structure. And in an ending diagonal, it would lead to problems. It's still a consideration in the back of our minds where maybe there is some zigzag family structure going on here, because sometimes a double zigzag mainly, like a wave W and then an X and then a wave Y, can look like an impulse while it is not an impulse. So there is still the opportunity of maybe counting a WXY in there, but still, even if you do count this as a three-wave structure in a 1, a 2, a 3, a 4, and here is your 5, and you're looking for an ending diagonal A, B, and then a wave C, which then is here a contracting diagonal, you want your wave 5 to be a three-wave corrective structure. And at the moment here, this move down here looks very much like an impulse to the downside. Your overlap in the beginning with your 1-2s, you move to the downside, sharp move, price is accelerating, volume increasing, and then you slow down once again. Preferably in wave 5, we would have seen a simple zigzag ABC or a double zigzag WXY. So preferably, we would have seen a 5, a 3, a 5, take the low, and then price moves towards the upside. But we don't really have that bounce up and then continuation down. Preferably this move towards the upside, which is then your wave B, is quite similar in size, or at least relative to the first leg down. But you can see here that we don't really have a nice like a 5, a 3. Like if this is A, this is B. Okay, well, maybe B looks quite similar to A, but then this has to be C. 1, 2, 3, 4, and a 5. Where preferably this is the low here. But your wave C is very long compared to your wave A. And if I take a trend-based subextension from the start to the end of A to the end of B, if we would count a zigzag here, toggle on the 1.618, then you can see that price moved beyond the 1.618 here, which increases the probabilities that this here is an impulse to the downside. Another wave A, B, and C. And otherwise, we can't really get an A, B, C in here. Maybe like I previously was considering before this move to the downside that potentially we had a W here, that's your W, we work on an X, and then you get another ABC down in a wave Y. But then again, you want to see that like a bit of a B, move down, move up, and a move down again, but price pretty much just went straight down. So from a probability perspective, this move to the downside counts best as an impulse. It looks best as an impulse. The volume pattern according to an impulse is respected. You move down, volume increase in 3, volume moves down in your wave 4s and your wave 5s. However, counting an impulse down here makes it difficult to label this whole structure, again, as a diagonal, as the highest probability option. Right? Now, price might follow like the conclusion of a diagonal. I don't want to make it complex, but this is all Elliott Wave theory, and it's important to realize that sometimes people are counting something wrong, but the price action still follows the expectation of the wrong count. It's just that the count is incorrect from an Elliott Wave point of view. So if price would move to the upside without touching the invalidation of a diagonal here at 90K, and you do this, then I bet people are going to label this structure here as a diagonal. However, this, as mentioned, is a high probability impulse down, and this is, if an ending diagonal, if this is a wave C, it needs to be a 3. So you need a 5, a 3, a 5. If you finish here, then yes, we might consider an ending diagonal. But this at the moment looks pretty much like a straight line to the downside, more so an impulse than a corrective structure. So if price moves towards the upside, I would prefer to label it differently, which is something that I have here in my folders. So the bullish count I have on my chart would be W, X, and Y, where we have a flat ABC, W, zigzag family structure X, zigzag down in a wave Y. I do realize that a double 3 sideways WXY, where wave W and Y are different structures, is typically a sideways corrective structure. So generally you have your wave W, you get your X, and you get your wave Y, where wave X retraces wave W quite high. Wave X retraces to about the golden pocket of wave W, not too shabby. You take it from the start to the end of W in that case. Golden pocket is quite fine for a wave X. But then you see that your wave Y here does move to the downside, and it's not your typical very sideways WXY. It's not very sharp either. Like sure, we have a bit of a move down here, right? We have a bit of a structure down, but it's not too far just yet. If I take a trend-based sub-extension from the start of W, end of W to the end of wave X, and I toggle on the targets for a wave Y, then currently we are between the 1 and the 1.236, which is a common target for a wave Y. So that is between 95.4 and 90.4K. So that is fine. The 1.618 at 82 would be very deep. That's the moment where you really start talking about different structures. But if we want to potentially end something at the low that is going to be created over here, I mean, it sounds like I'm very much confirmed, but probabilities are higher for a bit of a bounce. And that's what I keep in mind, like my directional bias at support as well, because we are at support levels. My directional bias is more interested for longs, like I'm looking for price to basically move up, and that means that I'm more interested in taking longs according to my plan. You should of course have your own personal plan based on your own personal data set and all that stuff, entry requirements, and then if that plan is respected and the entry triggers are met, then the execution follows. If your entry triggers are not met and your plan is not respected, there is not going to be execution, right? And you have to wait. Now the safest long really for bulls would be to just get a 5-wave up at some point, a larger 5-wave structure. Price never moves in a straight line. You will eventually get a corrective structure, and this is your high probability long. And an example that I always love to use, and you may have seen in previous content, is this one here from the range between 70 and 50K, where price moved down, it touched support. You can go back to my videos, start of May 2024, touch the aerial support, and if no long was taken down here, you can still see this is a high probability impulse to the upside. 1 2s, your 3, your 4 5s over here. You get a 3-wave corrective structure to the downside, and then eventually up you go. This over here is your area of interest. That is your area of entry. Stop loss from an Elliott Wave point of view would be below this low, but of course you can have SR levels to decrease the stop loss, increase the RR as well. But still, that would be your high probability setup, right? This is arguably here a more risky area of entry. From an Elliott Wave point of view, at least on the 4-hour, you can't really see what's going on here. I know that from the content back in the day and my memory, the probabilities were higher to move towards the upside here once price started forming this structure after the mess. But you can see that, hey, we get a 5 up, we look for a 3 down, and that is then a high probability entry. There's no reason to try and snipe the lows unless it's part of a plan. And sniping highs or lows, right? You just need to know what you're looking for. So if something finishes at the low, I would prefer to count it like this. There are other scenarios, but most of the other scenarios for the bulls would require price to take out this low one more time. And of course, we need one bullish and bearish scenario. And in a bearish case, you would just look for a move down, move up, and another move down. And this has to be a corrective structure, quite simply. And in a bullish case, you finish something at the low, and you get a 5-wave up and a 3-wave down, and then you look for price to create another leg to the upside. It's basically as simple as that. And if I go to a 1-hour time frame, then the trend and turn methodology, which has been incredibly efficient over the past, very long time, but in the previous live stream that I did on Saturday, I spoke a bit about this as well. Trend and turn methodology with the OSO sequence. So we have the overlap, price moves down here on an increased amount of volume. And we can see that price is slowing down, volume decreasing here as overlap returns. Price is curving sideways once again, creating a bit of a typical S structure. So you get this move down over here, and then you start moving sideways again. So you get that like S movement, right? This like wave pattern, right, so to speak. So you get this S type of movement, which is what we like to see if we want to look for price to create a bit of a move back towards the upside. Now again, from an Elliott Wave point of view, it would be nice to create another 4 to get a 1, 2, 1, 2, 3, 4, 5, maybe another 4, another 5. Invalidation is 100.6K for a wave 4. And then you look for final wave down if you do get another move to the downside. Now, an impulse to the downside here for the bears, you would look for a multi 1-2, which is by far the most bearish scenario. 1, 2, 1, 2, 1, 2, 3 down. It still requires a bounce though, preferably, because price here is slowing down. That's why it's interesting to look for a bounce. This move up has to be corrective, relatively similar in size to the move down, preferably. But the short-term bias is the same. If you look here for a move towards the upside in another wave 2, well, in the bullish scenario, you're also looking for a move towards the upside, but of course, eventually continuation. So the difference is management, but in both cases, your directional bias is actually the same. The only way, or the only scenario really where price just continues down would be if this is a 1, 2, 1, 2, and you're now in 3, and you then get 4, 5, 4, 5. So you have a multi 1, 2, 1, 2, 1, 2, 1, 2, 1, 2, 3, 4, 5, 4, 5, 4, 5, 4, 5, basically, and price continues down. But once you move into wave 4s and 5s, you still get you get a bit of a staircase structure. You have your move down, and then you get your 4, 5, 4, 5, 4, 5. It's like a staircase to the downside where you would still expect a bit of a bounce at relevant support areas. You just get a much more shallow move towards the upside, which has to be a corrective structure, of course, as well. So that is something to pay attention to, that if a bounce eventually comes, is it corrective? Is it motive? That is only, it's up to the chart. We just have to manage accordingly. If it is corrective, you're going to TP quicker, exit quicker. If it is motive, you might be able to hold on for a longer period of time, look for higher areas of resistance. I just don't really enjoy looking for so many 4-5s just yet because there's no proof yet. We still need to maybe get another 4-5, and after this 5, you need another 4 and another 5. And so it just takes a lot of time. And initially, this move down here is very short. So if this would be 1, 2, 1, 2, 1, 2, 1, 2, and this is your 3, that 3 is tiny. Right? In an impulse, 1, 2, 1, 2, 1, 2, 3. And then eventually, right, you get your like 4-5s, 3, 4, 5 over here. 3 is preferably the longest, strongest, most extended wave in an impulse. Now, of course, arguably one can say, well, what if 1, 2, 1, 2, 1, 2, 1, 2 here, 3, 4, 5, 4, and you get an extended 5, and you get a 4 and an extended 5, right? And you get another 4 and an extended 5. Now, you're going to have 1, 2, this is all lower degree stuff, and then you have a 3, 4, and 5. And now this 3 may be extended because of the length of the structure with the extended 5s. However, an extended wave 5 impulse is not as common as an extended wave 3 impulse. So the probabilities would be against counting this structure like this at the moment, where you get extended wave 5s to the downside to get the extension in the 3, which is most common. So 1, 2, 1, 2, 3, 4, 5, 4, 5. The only way we can really increase the size of a 3 of a higher degree is by getting lower degree extended 5s. It's just lower probabilities, and in the end, probabilities is what we have. No? That's the only thing we're dealing with. So locally here, based on the price action, with price overlapping, slowing, and then sharp move down, and then slowing down into areas of support, it just becomes interesting from a bias perspective, because Elliott waves in the end just gives us a directional bias in a way. It becomes interesting to look for a bit of a bounce. Now, if a bounce eventually exists, if a bounce comes, then generally the minimum target is the 0.382 taken from the high to the low. Of course, if the low here would hold, it's 98.5. I wouldn't mind, or I would prefer from an Elliott wave point of view to see another 4 and 5, just because it looks a bit more neat. 1, 2, 1, 2. We can clearly see 2 moves up here. You get your move to the downside. 1, 2, 3, 4, 5 here. You see the first range, another leg down over here locally, another range, another leg down. I would like to see that, preferably. It's not something I would enjoy trading. I wouldn't like to go short into areas of support unless there is clear weakness, and like maybe support is flipped into resistance with bearish CVDs and that sort of stuff. But my bias is at the moment looking for a bit of a bounce, and I don't mind missing a bit of a move towards the downside, because it's interesting to look for signs of strength at support. Now, if support is lost, I'm interested, of course, in looking for more downside, right? But then preferably you change into, you flip it. Support, lost, resistance, bearish CVDs, and then you go to the next level. You can see also support levels are quite close here. Area of support, currently respected, area of support, area of support. There's a bit of a bigger gap over here. So yeah, that's basically what I'm looking for at the moment locally. So the 382, if bouncing, it would be a minimum area that I'd be looking for. Okay, then we get to the levels, but let me now zoom out. These are the volume levels on my chart. The weekly naked point of control at 95.9 is already touched, but I have it on my chart because it's the upper boundary of the current bounce. So here are the levels. Volume levels are my personal favorites. This is definitely what I keep an eye on. Then, also related to volume, I have this support resistance area here between 88 and 89.5. And this also includes a volume profile value area low. So if I take a volume profile and I drag it from here to here, right? So from the beginning over here to this, to basically isolate this as a range, and this then becomes like an upper range. So now price then moved back inside this range, pretty much. That's why I take the volume profile the way I do. Then over here, we can see the value area high was respected multiple times. We lose it. We come back, retest the value area high. Next target, point of control. Not really holding, right? Not really holding, just not holding, because price moved through that point of control. Next level of interest from a volume profile trading point of view, like range trading using volume profile, would then be a value area low. Point of control lost if retested with bearish CVD or other signs you're looking for. Value area low is interesting, which is at 89, which also is in confluence with the support resistance level over here. So we have support, right? And then also here, resistance. Arguably, you could make it a bit bigger. There's, of course, a big support level here as well, but that is where we are at the moment. Plus, we have horizontal levels of support. But below here, there's definitely a bit of support as well, besides the value area low of the range that I just showed you. And then we have time frame horizontals. So here's the time frame horizontals that I have on my chart. Of course, we have resistance order blocks here as well. The one that's closest is 101.3 to 103. And then we get to the news. So here we go. Economic calendar on Hexaplan. Yeah. So Hexaplan is a platform Jeroen and I are developing to help people create their plans, but we also included an economic calendar. It's not yet finished. We are in beta testing. There's currently 50, 60 people testing the platform, providing feedback, Jeroen updating everything, and we're having meetings all the time and thinking where can we improve, what to add, what to remove. And we added an economic calendar as well, really, really nice. And I think it's actually publicly available. If you go to hexaplan.trade, let me show you the link here. So there we go. It's hexaplan.trade/economic calendar. If you want, then it's really, really nice. So here we have this week, it is set to United States time zone, Paris or Amsterdam, or at least Central European time zone. And then this week here, we can see that on Wednesday and Thursday, we have some news. Now, I don't really expect much on Wednesday, a bit of FOMC minutes, but on Thursday, that can be interesting here. We have NFP as well, unemployment rate. So around 1:30 p.m. Central European time can be interesting. Actually makes me wonder if this is winter time, like this is brand new. So updates are going through every time, but generally news is 2:30 p.m. from memory. So I don't know, 1:30, 2:30. Take it with a grain of salt. I might have to double check. We're now in winter time as well. So, So yeah, that is the news. Then we get to the conclusion here. So conclusion, I'm not a big fan of counting a multi-1-2 to the downside, where this move down from 106 to the current low is a wave 3, being a 1-2, 1-2, 3, and then 4-5, 4-5. I don't really like it. The 3 is just very tiny, as I say here. It's really short for a 3. The volume is very average. Preferably volume is highest in the 3. Nothing is extended, wave 3 that is. If bearish, I would prefer another wave 1 and another wave 2, which in the end, wave 2 would create a bounce anyway. Bulls at the same time would look to finish something, because your bearish scenario is always going to be like take the low again, like a couple of 4-5s, then a bounce. Bearish scenario is always going down again. But what's the bullish scenario? If you want to finish something here, what would you count? Well, the WXY would then be the bullish count. But of course, the bulls are then just looking for continuation to the downside. 5 waves up, 3 wave down, and then price moves towards the upside. So the short-term directional bias for both of these scenarios is the same, while just straight continuation down to much lower levels seems to have lower probabilities based on local price action, with how price is curving, volume decreasing, no clear extensions to the downside. In both cases, the bias would be up with the trend and turn methodology in mind. Also, we are at support, and we have some support below price as well. And then if price would bounce towards the upside, the structure up will let us know more. Is it 5? Is it 3? We'll follow along. If price continues to the downside, that is, and wave 3 is already finished, and now we're working on like multi 4-5s, being 1, 2, 1, 2, 3, and eventually we get 4-5s over here. So again, 1, 2, let me go to a 4-hour time frame. So we had that 1, 2, 1, 2, 1, 2, 1, 2, 3, 4, 5, 4, 5, 4, 5, 4, 5, right? That's basically the final paragraph here. If price continues to the downside, and wave 3 is already finished, and now we're working on like 5 multi 4-5s or 4 multi 4-5s, it would create a staircase structure to the downside where it's range drop, etc. The ranges preferably get longer, and this still leads to a bounce up. So preferably here, even if we're looking for 4-5s, I would preferably still get a bit of a move to the upside here, right, at areas of support. It's just that the bounce that you then get is going to be shallow. It's going to be a more shallow sideways ranging structure, not going too high, but it's going to be more shallow. It just doesn't at the moment have the highest probabilities. It's too early to start labeling like so many 4-5s after this amount of 1-2s. And preferably, if you are looking for a multi 1-2, you get an extended wave 3. And I think a great example of this in a previous bull market, let me show you here as well, because, examples do the trick. So we have the high here at 65. You can see here as well, you get like, whoop, 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 boom, right? And that is something that you just like to see that, right? Like a multi 1-2, and then eventually you get the 3 to the downside. I actually didn't really need to go that far, because preferably this would be an impulse down based on the structure, and then you would have boom. You go to the downside. Alternative would be WXY. So also aware of the support below price, the daily naked point of control at 91.6K, and the SR area below that around 90, 89. And price is currently at support as well. So yeah, that is it. I hope you have a great week. It is Monday, so let's see what the market is going to bring us. Hopefully an exciting week with some more volatility. And that being said, I hope you enjoyed this video. Thanks for watching. I hope it was helpful or valuable. On the left, you see a video on the simplest way to use and trade Elliott Waves without even counting. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott Waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye-bye.